All right, the Federal Reserve acknowledging inflation. Here now is Danielle DiMartino Booth, author of Fed Up. So Danielle, does the language we saw in that May statement where the Fed says inflation has moved close to 2% versus what we heard in March where it was running, quote, below 2%, does that lock in a fourth rate hike this year?
I don't think it locks it in per se, but I do think that Jay Powell, that this is a shot across the bow and him saying, come on people, 1.9%, 2%, you're splitting hairs.
1.9% on the core PCE.
1.9% on the core PCE. If you look at any other inflation metrics, the ones that you and I actually have to deal with in real life, price increases on planet Earth, they're all running core CPI, CPI, headline PCE. If you look at any of them, they're all at 2% or above the Fed's target right now. So he's saying, this is the one last straggler, and it's right there. It's at 1.9%. I think this statement says we can go in December if we want.
Well, and to your point, the Fed added the word symmetric to its 2% target. Explain what that means, essentially.
Yeah. The one I want to explain what it means is Jay Powell himself. I can't wait for the next time he's behind a microphone and being asked the question himself. Because I think what symmetric means, that a lot of people interpret it as being very dovish, that it gives, that let's say core PCE rises above 2%, and they put an inflation range out there of 1.5 to 2.5%. Well, that means that the Fed actually has license to be more dovish and say just because inflation's running hotter means we don't necessarily have to hike rates. I think Jay Powell would tell you by that same token, if you're going to say between 1.5 and 2.5, that 1.9%, that's fair game for a fourth rate hike in December. So he is the most data-dependent, truly data-dependent Fed chair I've ever seen.
But we always hear Federal Reserve officials in their speeches at events talk about inflation, but the statement had quite an abrupt nod to inflation.
It did.
That speaks volumes to how the Fed's thinking.
This was not a lame duck, no press conference, therefore we're not going to make any waves statement. It was not. He took the opportunity of May, despite the fact that there's no ability to further explain it via the press conference. He still, as to use your word, abrupt, he still changed the language.
Let's put the symmetrical issue aside for a moment, because we'll say the Fed has declared victory on inflation, right? They're at 2%. They also met their unemployment target. So what does a central bank do after achieving their dual mandate, essentially?
Well, and it is telling them that the economy can withstand rate hikes. That it is telling them that whatever their version of neutral or normalized interest rates is, that they have license to go there because the economy is where they need for it to be. They're not going to harm it with more rate hikes.
Yet we know Jay Powell has a background in financial markets.
Absolutely.
He has a lot of experience dealing with CEOs of industrials companies. If you go on those earnings calls, all you hear about is rising freight costs. What does that mean for inflation?
Rising freight costs, rising lumber costs, input costs are squeezing margins. Any company that has to put anything on a truck in this country is getting squeezed. He's listening to that. So the question now becomes one of, is this an inflation scare, or is it going to follow through to consumers? Is it going to be swallowed by producers, which is going to compress margins, which will slow down the market, which I think the markets are very well interpreting, or is it going to stick, therefore, again, giving him license to raise rates? He's listening to these CEOs. He's getting briefings on the earnings calls. He is following very closely what's happening with margins, because if companies get squeezed too tight, what do they do to cut costs? Layoffs. I mean, there was fresh layoff data this morning. It's been years since I heard John Challenger be even remotely bearish. And he said in the press release today that he was worried about what's coming because there's been so much M&A activity. When you merge, when you acquire other companies, in order to achieve that lovely other word that starts with S, synergies, that typically means layoffs. And John Challenger Gray and Christmas Layoff Report, he's starting to pay attention to it.
And to add fuel on the fire, essentially, we know that tariffs are largely viewed as inflationary.
That's right.
So that's another sort of challenge for Jay Powell.
Well, and we've heard, again, from the companies, we know tariffs are by definition inflationary, but they haven't actually been necessarily shoved down the throat of other countries, yet. We've got armies of people traveling to China to do negotiations and play hardball, and there's all this rhetoric flying around. Back here at home, companies are panic buying because they're trying to get in front of potential tariffs. When you panic buy, you push up prices regardless of whether there's follow through with the tariffs or not. That's inflationary.
So let's talk about the market reaction to all this lately. Spreads on yields between the 2 and the 10s continues to narrow.
They're compressing. They're compressing. The 10-year at the most recent glance was at 2.84%. Excuse me, 2.94%. I mean, we held 3% for 48 hours. Really? So I think the bond market is taking the more dovish interpretation.
Were they too hawkish?
They might have been. They might have been, but again, there are so many. We've just gone through 2 different layers of unknowns. Will companies be able to pass prices along to consumers, which would push that core PCE way above that 2% target? Will tariffs happen? These are 2 huge unknowns. But if either of them comes to fruition, if pricing power is truly existent, and if the tariffs go through, the inflation's real. So Jay Powell was right to put it out there yesterday.
So what does all this mean for what he now has to say in June when we are widely expecting a rate hike? I mean, we should point out there was no rate hike at the May statement.
There wasn't.
Yet there was all this activity.
But the market felt like it was because this was not a dead statement. The statement moved markets because the statement changed materially. And by the end of the trading day, markets got it and didn't like it one bit because they want their candy. They want a sugar daddy running the Fed, not Jay Powell.
So if we see some sort of bizarre volatility in the coming weeks because of the Fed, I mean, he's essentially set up for failure in June in some respects.
Well, I think June is baked into the cake. I think that what investors are looking out to more is September, December. And now that he's made May live, good God, what's going to happen now we're talking about 8 meetings a year potentially being live events. Markets have grown accustomed to that number being 4. So now they're on higher alert. This is like DEFCON 2, not DEFCON 1.
Okay, we'll continue to watch how it plays out. Danielle DiMartino Booth, thank you.
Thank you.